Okay, so this is the panel on the preparers and users of financial statements. Now that's a huge topic area. So the way we're going to do the panel is actually break it down into 3 chunks. Kimball and I had conversations with each of our panelists ahead of time. And by the way, even though I'm moderating, Kimball did a lot of the heavy lifting on this panel, so he deserves a big credit for that. We're going to break it down into 3 topics that I will pose to each of the panelists. But beforehand, what we'll quickly do is just go down the line and introduce ourselves. And as we introduce ourselves, I asked the panelists to comment on the extent to which academic research affects their work, if at all. So I'm Ed Dahan. I'm an associate professor, and it definitely affects my work a lot.
I'm Scott Bogus. Until February of this year, I was at the SEC as the deputy chief economist. I'm just finishing my post-government detox in the summer. I'm heading to Austin to join the University of Texas faculty in the finance department, and one of my roles there will be to direct a new program in financial market regulation, and I'll talk a little bit more about this in the final panel, but I hope to solve a little bit of the last mile problem in getting academic research to be relevant in policy. At the SEC, I spent a decade doing economic analysis on policy. The first panel talked a lot about DERA, the Division of Economic and Risk Analysis. When I joined, it was a sleepy office of about 30 or 40 staff. When I left, it had shrunk to 150 staff, of which about 60 were PhD financial economists, accountants, working on a variety of topics, mostly policy. They did their own original research. They published in academic journals, and they wrote the economic analysis for the proposals and adopting releases of new rules. The SEC and the staff there are also very large consumers of academic research. 60 is a big number if you think about academic departments, but it's a very small number in terms of the purview of the SEC. And I'll say that academic research, the accounting research in particular, because disclosure issues almost always touch accounting. It was mentioned in the last panel too. It's hard to find a number that accountants haven't touched as a big part of it. And we did a study from, the SEC lost in the courts 8 times in a row on rule challenges. The most recent in 2011, proxy access. 4 of those losses were on the economic analysis. So in 2012, there was new guidance issued on best practices that should be adopted in economic analysis. And in 2017, we did a 5-year review of how did our practices changed. And in part of that review, we looked at what academic research is being cited. And some statistics that were produced showed that of the journals that were cited in SEC rules, 2 of the top 10 were accounting journals. If you looked at the papers that were cited, it turns out that the most cited academic, and I won't embarrass the person because they're in this room, is actually an accountant. They had 5 papers cited, a total of 9 times over a 5-year period. So accounting research is extremely valuable at the SEC in the policy making process. And I guess I'll finish by pointing out a comment about the very timely release of the new 404B proposal, which is talked about a bit on the first panel, right before this conference. And the panelists there said you should look at the economic analysis of 404B, the proposal, to get an idea of what an economist do at the SEC. And it really is broken down into 4 components. The first thing you have to do is articulating the economic analysis is identifying what the market failure is. The accounting academic literature has a lot of research on 404B. We've learned a lot since Sarbanes-Oxley, and a lot of that is cited in the release. So identifying the market failure, creating a baseline to which compare the changes is very important. This is where stylized facts in academia really matter. To understand what an impact is going to be in the market, you have to understand what the market actually is today. And there's a paucity of stylized facts in academic literature today, from my perspective, and that's I think something we can talk about a little bit too. Looking at the effects of the change aren't just cost-benefit analysis. It's also, we call it an economic analysis because it also includes the impact on competition and capital formation and efficiency in markets. So it's much broader than just looking at the individual components. And then measuring the relative impact compared to the alternatives not taken, not just the status quo, is a very important part of the process. I think it's interesting that the CARE conference organizers invited 2 commissioners to speak, one this afternoon and one tomorrow morning, who are at polar ends of the 404B debate, and hopefully they'll talk about it a little bit. But Commissioner Jackson actually issued his own economic analysis, separate and apart from the SEC, and has some views. And if you listen to what he says, it's hard to disagree with many of the arguments he makes. And if you listen to what Commissioner Peirce says, if she talks about this, it's going to be hard to disagree with many of the comments that she makes. And so it's going to be really interesting. And I'll say before I left, and I worked on 404B for over a decade at the SEC, and the one issue in terms of the market failure that we tried to articulate was you have to look at what is the change you're going to make, or what is the economic rationale for all of a sudden changing this threshold, and that's where revenues came in. Is we had many early discussions with the Chief Accountant's Office, with the Division of Corporation Finance to say, well, what is it that's going to be different about certain small reporting companies that make it that compliance with ICFRs and audit attestation should be changed? And this is an excellent area for academics to engage in today, is to give your views on whether or not that's an appropriate indicator to use in exempting 404B for smaller companies.
Wow, that's a lot to follow. There we go, thank you. Yeah, I have to ask the SEC for this. So my name is Mary Conway. I'm almost afraid to admit it after our last panel, but I'm actually a consultant. I have been in the investor relations field for more than 25 years. I've had my own company for 20 years. And in that role, I work with companies across the spectrum from microcap to large cap. And in terms of their business, we're agnostic. We go from life science and financial services to technology. It can vary. In that role, obviously, we're doing a lot of work on the production of materials, disclosure materials. We've seen a lot of changes in the past 25 years. FD obviously is one that people think about a lot. What's most scintillating for us in some ways is that while our methodologies, our channels, our speed, our pace, the issues we have to deal with have changed really ginormously, as my son would say. Some of the regulations and some of the limitations of regulation have not changed at all. One of our pet peeves tends to be, when 13F filers are telling you their positions 45 days after the end of the quarter when they bought it at the beginning of the quarter and they sold it already too. So, you're always trying to catch a falling knife. And then we're also dealing with things like program trading and, the rise of passive money. So you actually can't even know who your shareholders are. So that, we have a very people don't really know what investor relations folks do, and our roles are getting more arcane and more specialized all the time. We get things like ESG thrown at us, and governance issues. So it's really quite fascinating. I'm passionate about investor relations, which is why I'm here. I was brought into the realm of academic research on IR by Eugene Soltis at HBS, and really have grown to perceive how incredible the energy and enthusiasm that you folks feel about our field. I think we have some innate challenges in that what we do tends to be a bit idiosyncratic. I was teasing with someone the other day, or last night, who said, the firm, and I said, well, I know you all think about the firm as sort of the guiding light, but for us, it's actually management, and that is a very human element of any firm. You change a CEO, you change a CFO, and the firm's tenor and practices will change. So it's something. There's just a very important human element, even though we have things like program trading and machine learning in reporting and things like that. So those are things that keep us up, and we're always sort of trying to make sure we adjust our perspective and our advice and what we do for those circumstances.
Great, I'm Todd Castagno. I'm from Morgan Stanley, equity research analyst. So our client base is large institutional investors, buy-side investors, which could be anything from pension funds to hedge funds to long-only mutual funds. Within equity research, I wear a couple different hats, but primarily focus on accounting and tax policy, as well as how that interrelates with equity strategy. And I also chair some of our technology initiatives, which I think, as part of this conversation today, technology is a big driver of how investors interact with disclosure and information, and even investor relations, and how that's rapidly evolving and changing. and as well as just the evolution of how asset managers manage assets. It's becoming more systematic, more quantitative. I'd call it more disciplined approach, less human-oriented or solely oriented. So that all interrelates with how we approach managing assets and how we consume disclosures, and the regulatory interactions there I think are interesting. In terms of academic research, I think two ways we interact with it. One, you might not realize it, but a lot of these clients, particularly the quantitative systematic, are taking your papers and trying to put them in practice. That is one of the hottest demands on sell-side research, is taking one of your papers, putting a little special sauce on it, maybe talking about potential limitations or opportunities, or combining with different factors or strategies. And it's extremely common. The other way I'd say we do that as well within Morgan Stanley. We can talk about that, some of the things we've done with tone and sentiment in that literature. The other thing is I commonly work with you all on how analysts approach the world, why they do the things they do. I know I read some of your literature and you wring your head and why are they doing that? Why are they making those biases or those errors? And sometimes there's good reasons, sometimes there's not. But we work with you frequently on that, and we'd be happy to have conversations on that side of the research topic. I also serve on the FASB's Investor Advisory Committee, and so Hal has the pleasure or displeasure of seeing me twice in 1 week. So we had a meeting the other day. And then I also co-chair in the U.S. the Corporate Reporting Users Forum, which is a group of sell-side and buy-side analysts that generally try to respond to disclosure and both FASB and international standard setting.
So I'm Kimball Chapman. I'm an assistant professor at WashU in St. Louis. Many of you know the responsibilities of an assistant professor, so I will spare you the lengthy description. Hopefully one way I can try to add some value on the panel is that I spent the first decade of my career in practice doing investor relations work for the last 4 or so years of it, so I feel a special kinship with Mary in that regard. Including my doctoral program, I've got, I'm approaching a decade in academia with a decade in practice, and, so in terms of how we can, keep research relevant for practice, a couple of quick observations I would make is that when I came into academia, I discovered a whole bunch of really relevant research that I didn't know existed when I was doing, disclosure and investor relations work in practice. And some of it was even quite accessible, right? So I found myself thinking, oh, well, I wish I would have known this. This would have been really helpful to me. And there was another category of very relevant research that was much less accessible in the sense that it took me, multiple years of climbing a steep learning curve in a doctoral program just to be able to understand it and read it, let alone try to, produce some of my own. But those could give very relevant and neat insights with, tight causal identification. But the learning curve to understanding it coming from a practitioner background was long and steep, right? So I think, to some of the discussion we've had in the earlier panels about this intermediation task, certainly I think it's quite a significant task from my perspective based on, my experience. And in other areas, I think there's some low-hanging fruit in ways that we can sort of bridge that gap. So that's all I've got for an intro.
All right, great. So I'm going to keep us moving here on a pretty tight schedule. I've had some fascinating conversations with all 4 panelists, and it seems to me it's a really exciting time to be in disclosure research, really on both the researcher side and the practice side. So on the researcher side, I think there's a growing acceptance in the field that there are costs to acquiring and analyzing firms' financial statements. And if there's a cost to it, then there must be a benefit. There must be profit opportunities. And if we have a friction, then there's going to be some inefficiencies in the marketplace, illiquidity, mispricing, et cetera. So, and also when we have frictions, we have room for regulation potentially to help alleviate those frictions. What I heard from our panelists on the practice side is that the world is changing very, very rapidly. The role of technology cannot be understated. And the consumer, the main consumer maybe these days of financial statements is a computer. And so financial disclosures become more data than paper. A 10K is not a novel read cover to cover. It's a source of data that is extracted primarily by machines. So on that topic, on that note, the first of the three topics we're going to talk about is the role of high-quality machine-readable data. What are the costs and the benefits? We've seen regulators stepping into this space with EDGAR and XBRL. And I'm going to turn that over to Scott to start with.
Thanks. It's a topic that's near and dear to my heart. It's not necessarily pedagogically interesting from a research perspective, but it's incredibly important for research productivity. And I'll say, working at the SEC for over a decade, it's a legal-centric organization. Lawyers tend to think in terms of 8.5 by 11 sheets of paper and reading, and what gets lost are the technology and analytical component of the disclosures that are being made, and that manifests in two problematic ways. One is that the data is often inaccessible, and two, it's often unusable. You can get in a room and talk to a bunch of policymakers about the merit of making a disclosure, and once they've decided item X needs to be disclosed, they stop and they don't think about the standardization across various registrants. If you want to do comparability in the cross-section or the time series, is this the right way to measure it? They don't think about, well, in what format do you want to make it so that it can be easily extracted and used in research. And these are things that we worked on for a very long time, not always successful. I'll give an example of 404B. The measure that I hate the most at the SEC is the market value of float. This is something that a lawyer created because it made a whole lot of sense in terms of we only want to count the market value that's touching the investors. But it's subjective, it's hard to measure, and it's impossible to procure, yet every decision that's made at the SEC is made on it when it would just been so much simpler to say market value, and you probably wouldn't have lost a whole lot. And there's lots of examples of standardization where the perfect is the enemy of the good, and you just make this decision because it made sense in a vacuum, but not in practice. There's some good news. There was a chairman, Chairman Cox, in 2007 and 2008, who passed some rules to create business reporting language, or to use the business reporting language, XBRL, to report financial statements. Large accelerated filers for the first time are going to report an inline XBRL. If you haven't yet gone online to see what an inline XBRL document is and looks like, it's pretty amazing. It's an HTML document, it's a standard disclosure, but it's very interactive in terms of the information that you can extract from it. And what's interesting is the vendors are now using the IP that the SEC made publicly available to create analytics that can be built into the actual document. So it is going to change the way investors use information from disclosures. There are many other machine-readable disclosures that are being made outside of accounting, swaps, a lot of XML-based formats. So that's a decade of improvement for regulator making information readily available for researchers. The bad news is that the data quality is still rather poor. The standardization in the data is rather poor. And I think if you look at the XBRL data that the SEC has been putting out for almost a decade now, the people who use it, or the entities that use it, are data aggregators who are then cleaning it. I think there's very few researchers that actually use the XBRL data because it requires so much effort to standardize. The SEC has not done a very good job of making companies comply with the spirit of the rule. And it's amazing, if you're a layperson, you think, well, revenues is the same for everybody, the top line number reports your revenues, yet about a third of companies use a custom tag for revenues. And so automatically that makes it non-comparable without some effort. Well, why did they do that? Well, because before XBRL, they called it a certain name on their 10K or in their balance sheet or in their income statement, and then they said, well, that standard tag doesn't call it that, so I'm going to create a custom tag so I can use that same verbiage. And the SEC never said, well, don't do that, because the SEC allows a lot of discretion, so it just made the information not usable. The voice that's missing and is not complaining and should be complaining are all of you that are academics saying, well, why don't you make this more usable? And in general, I've found there's a lack of incentive by the industry, those that are reporting the data, to clean it up, because all things equal, they prefer opacity and less examination of their information, so they don't have the incentive to make it available. They actually have complained, and there's bills in Congress that have sought to exempt XBRL reporting for smaller companies because the burdens were too high. But the burdens actually, I mean, it's no more than filing a TurboTax document. It's not really that difficult, but it's the perception that it is, and they try to lobby to have it removed. And it was interesting, and I've talked, of all the items I've talked to the Hill on in my time at the SEC, this is the one that I talked about most frequently. And at one point I told the congressional staffers when they're trying to figure out, well, I want to exempt this, this threshold, how many firms would fall out. And I said, the only reason I can give you that number is because they're reporting with XBRL. Absent that, I wouldn't know, because CompuStat doesn't cover the bottom third of the public reporting universe. So it's that irony that often existed in regulatory reporting, and the voices that tend to win on these issues are industry, because academics don't tend to comment on things that seem to be obvious. And a great example of this is recently in the FAST Act adopting release, whereas the Commission had previously proposed to use a legal entity identifier for public companies and their subsidiaries, they got rid of it and said you're going to report ticker instead. Now, from an academic perspective, I'm pretty sure most of you would say ticker's a pretty useless identifier. But the reason in the economic analysis, and I'm a little dismayed by this, that was cited for this change, is it would be costly and time-consuming to acquire and maintain LEIs. I'll insert they cost $75, particularly for registrants with numerous subsidiaries or affiliates operating globally, while at the same time, LEIs may not provide additional material information to investors. If you look back at the financial crisis and the Dodd-Frank Act, the one thing that I think everybody agreed on was the fact that we couldn't deconvolve the credit default swaps at reporting entities and understand the risks was a great reason to have LEIs. And now the $75,000 that a bank would pay to get them is too much. Nobody in the academic community said this would be good to have LEIs, and it got struck from a rule. And I think it's a big blow to the regulatory community and to academics who want to do research and now can't make connections between firms and their subsidiaries. I guess a couple things that I would say to end in terms of what can academics do to help. Making comments on XBRL and the quality of the data and trying to use as reported data would be extremely useful, because the common refrain from the commissioners is nobody ever complains to me, so why should I do anything about it? And I'm sure I'll be thinking, well, it's obvious and somebody should just fix it, but it's not obvious, and you are a very good voice for doing that. I guess let me end there, and I may have some more comments depending on what my panelists say.
Todd?
So I will agree and disagree a little bit. Well, just add some context, I guess, from practice. One, there are certainly some flaws within the XBRL, particularly on extensions and data quality. And I'll give you an example. I'm trying to look at the new lease accounting to see what the average term is, and I think this firm has the third highest amount of operating leases being capitalized, and they just didn't tag the term, right? So we still have to go back in and do things manually. However, there have been technology solutions that we use that are basically kind of retrofitting and fixing the issues. And increasingly, year after year, they're becoming better and better and better. So we're working with vendors that effectively are trying to accommodate a lot of the weaknesses of XBRL, the comparability, the extension issues, the data quality, and it's becoming more and more reliable if you add that technological analytical layer on top of there. Now, that's great, but those power tools really accrue to only a few number of large investors. Like myself and some of our clients. If you're more of a smaller broker or smaller individual investor, you don't have that. So speaking with regulation and how we perhaps divide that gap, I think that is something we should consider as policymakers and certainly academics. The other thing that you hit on that I think is core to the future, and how has done some work on this, is accounting standard setters and the reporting framework today is paper-based, but that needs to evolve, and it is evolving. And what that looks like in the future, I think, will dictate how we develop machine-readable technology and how that's disseminated to investors. And then the last thing, you often hear that no one uses XBRL. That's not true. I think a lot of investors are using it, they just don't realize it. Like you said, most of the big vendors are using XBRL. Their data quality actually has been better because they're doing it machine readable versus a bunch of offshore people typing it in by hand. So we actually have seen that. You might have seen, I've seen noticeable changes in quality in CompuStat, for instance, as they've connected to XBRL and have added the cleansing functions that are needed.
Kimball or Mary, do you want to jump in on that at all?
Well, I am curious if anyone has a perspective on the incentives. You know, Scott sort of brought this up, that there's a preference for opacity. That seems to be the case from issuers. That's driving a lot of these custom tags. You know, is there a, you know, Todd or Mary, do you have a perspective on that, on those incentives, or what's driving that? Is that what you're, you know, seeing from your clients, for example, Mary?
So I'll weigh in a little bit. Again, I probably should say my opinions are my opinions alone. They don't represent NERI or anybody else. I have a number of clients who do report, let's just start with revenues, that they're not, they do start with GAAP revenues, but then they do as reported. They may do constant currency revenues. You know, there's a range of reasons. Typically, companies don't do anything unusual within their small peer group. So you wouldn't have one company coming up with their own sort of unique, interesting, unusual way of reporting revenues. Everybody in their peers, all of them would be doing it the same. And, you know, the analysts on that group would also be looking at that sector, would also be accepting that. So you know, whether, is that good or is it bad for our country? It's kind of above my pay grade. But I think people, investors certainly accept it, and they find it useful, and they find it more meaningful, perhaps, than simply the GAAP recitations. There's just limitations to it. So I would quibble that companies prefer opacity. The companies I work with, they want to be as transparent to investors as possible. I think one of the challenges actually with a lot of machine readable information is that it really dumbs it down. And so, for instance, you know, we're talking about 10Ks and 10Qs, that's one thing, but there's a lot of words in those too, and people are scanning those words and scanning changes in those words to you know, divine meanings. And at the end of the day, most companies are more than just numbers. I mean, the numbers are very important. I understand my audience. I understand what I do for a living. Numbers are very important. But at the end of the day, companies have missions. They have purpose. They're doing things. They make widgets. They create all kinds of wonderful things. So to diminish a company into simply, you know, what is in their filings, and to kind of dumb it down that way can really, I think it harms the investors in a really important way.
Yeah, I'll just add to that. I think what you produce, if I could ask the average analyst or an investor to rank order their communications, it would be the IR deck, it would be the conference calls, the conferences that they attend. Those are top of the stack. And it's actually incredibly, I think the information efficiency in those documents are really quite superb. And there's a lot of time and effort, and it's meant to convey what management wants to convey to their core constituents. And also the timing, right? I think that's something that is to be noted, because the press release and the conference call and the IR deck comes out immediately, and you have a lag. And I think some research showing that lag is growing larger between when the Q and K comes out. You know, and that has consequences as well.
So then a quick follow-up on that, should we standardize that information? If you're saying that's the most efficient, or maybe it's the most timely, you know, right now that's in PowerPoint format, I would think, the IR deck, right? I mean, is there a role for tagging of, you know, I know that's going to be very company specific, but, you know, is there a role for creating more automation, or, you know, streamlining how that information flows to the market?
I think if you ask some, would you like to mandate tagging? It's a yes, but I think technology is almost there. And a lot of the major vendors are actually, FactSet, for instance, just announced this. Bloomberg has it. They have the non-GAAP reconciliation. So they're reading the IR decks, they're reading the 8Ks, they're categorizing and normalizing it. So we're consuming that non-GAAP information systematically. I couldn't do that 3 years ago. They are, like you said, a lot of the KPIs in a particular industry are actually quite similar. they're categorizing those KPIs, they're storing those KPIs, they're storing analyst revision of those KPIs. So I think the technology is kind of ahead of the tagging. I just wonder if you mandated tagging if we end up taking a step back.
All right, I'm going to keep us moving to our next topic. I feel like we could do a whole session on just that. Something that really struck me that I wasn't personally aware of, but I heard it from two of our panelists in conversation, was that the sell-side research is really fundamentally changing, and in fact declining for certain sectors of the market. And so I'm interested, I'm going to pose this to Todd first. What are the regulatory and economic factors contributing to that decline in sell-side research? And what happens to the market? How are buy-siders going to make investment decisions without that traditional sell-side research that we've had?
So I think there's currently two large drivers, and one is a secular driver, and it's the fact that I think everyone knows here that active managers are having difficulty generating their rent, so to speak, and generating outsized their returns. And that has led, I think, to some, particularly in Europe, some more regulatory focus. And so with MiFID II, which is a large body of new regulations, within that there's a couple paragraphs that particularly hit sell-side research and requires basically the unbundling of the commission between execution and research. And the goal there is to make the research, to make managers accountable for the research spend that ultimately accrues to the investor, and make that transparency. And so what has happened, and while this is mainly a European focus, is all of the active managers are rationalizing the brokers and who they do business with. And there's been technology tools to help them do that. And so if you're getting efficiencies, you might as well use those efficiencies elsewhere. And so what we're seeing is those large international funds take those tools and apply them in the United States. And it's quite literally, we had a fund come in, they were literally doing business with 80 brokers. Probably don't need to do business with 80 brokers. So they go, what are my top 30? And they go portfolio manager by portfolio manager, and they figured out who the top 30 were and cut the rest. So what that logically means is there's going to be less people covering stocks. I don't know if that's necessarily a bad thing. Do we need 45 analysts covering Apple? Probably not, right? But it's going to have other consequences. I think our view, and perhaps this is slightly biased, but some of the smaller brokers are going to have a tougher time. That don't have the coverage, that don't have perhaps some of the relationships, and more business might accrue to larger brokers. Or what we're also seeing is specialty brokers, or specialty analysts set up shop that, someone's covered industrials for 25 years and they have more relationships and knowledge of that industry than others. But it really is hollowing out the middle, and I think you've seen a drop in analysts, you'll see a drop in sell side. I could say even in Morgan Stanley, this affects us, analysts have to cover more companies. So it's already a resource-constrained business. I mean, if you think about what sell-side research used to be, is you have one analyst, he might cover 7 or 8, 9 companies, and he'd know those companies inside and out. Increasingly, analysts are going to have to cover 25, 30 companies. That's hard to do, and that's going to create inefficiencies with what we're supposed to bring as information intermediaries. So, I think there's research that shows if you have a drop in coverage, that creates less efficient markets, and so it'll be interesting to see how that translates. Also, we're changing the way we service our clients. Again, more and more of our clients are becoming more quantitative and systematic. So our product offering now is changing as well. We're actually trying to put together proprietary data products that we can sell clients. So, for instance, I'm working on something where we clear options, so we can put together an options probability model for particular equities and show what the market's pricing in 3 months, 12 months out. So things like that is how we're evolving. We're doing more consulting services instead of just picking stocks.
So let me address some of those things from a producer side. A lot of the diminishment in sell-side research has had a really deleterious effect on issuers. I completely agree that the 30-second analyst on Apple conveys absolutely no value. I have no ability, however, to say, hello, stop covering Apple, because they're covering Apple because their firms are trading in Apple stock, and they need to be represented there. It really does create massive problems, not for IPOs, because IPOs will have covering analysts, but as those covering analysts leave the firm, they go, we see more analysts actually now moving over to investor relations because they feel that that's a job that they can do. You know, you see more of that, then the firm drops coverage. And it's not simply that, oh, we were covered by 6 analysts and now we're covered by 3 analysts. It's that it has a lot of other implications. For instance, if you have a covering analyst, that means you're probably getting invited to their investor conference. That's an important opportunity to market your stock. Yet that firm was probably taking you out on NDRs, non-deal roadshows, going all around the country, around the world, meeting investors. That's probably not happening. Some firms are actually better about that, and those of us who've been in the business a long time have relationships that we can call upon, but it's much harder. So what you're doing is you're really limiting, all of a sudden, a company's ability to market to investors. And there's other things, you know, corporate access in general. The bus tour doesn't stop at your firm anymore. So it just has a kind of a cascading impact of effects on issuers when we have that. And then to your other point, you know, that the analysts are so overworked. You know, we'll be on a call, a post-call call with analysts, and you know they've got 15 minutes with management, and they've just had 2 other calls with 2 other companies. They can barely remember which one. Were your revenues up or down? I'm overstating it slightly, but they really, I mean, and these are really smart people. I mean no disservice to them. They have to produce a report that says something meaningful. And some of them actually have said, you know what, we're not doing post-call research anymore because, you know, anybody can be a stenographer, and that's all you really are at that point. So they've changed their whole focus to be more, you know, they try to do pre-call reviews. Of course, then they're wrong sometimes, and then that creates its own problem. But you know, it's that world has really changed. The lifestyle and role of the sell-side research from one who really was a partner in helping to be a megaphone marketing a firm, a company to the investors. Now there's fewer investors since many of them are passive or you know, program traders, and the quality of the research really has diminished. So,
And I can see this live. These trends incentivize for the analysts, incentivize herding.
yeah.
Because you just don't have time, so let's just mark to market. What's the consensus? And they're incentivized to take more big bets on 1 or 2 specific companies. So they'll get to know one company really, really well. This is how I'm going to differentiate myself. I'm going to put my flagpole out there, and then I'm just going to mark to market everything else. And I know there's some academic research on bundling. You can see that. So when an analyst updates 15 models in a day, there's probably less information quality in those updates than when he comes out with a stock that he hasn't written on in, you know, a month.
I would say that MiFID II is one of the questions that when I was at the SEC, our investment management division frequently asked us, Division of Economic and Risk Analysis, to weigh in on what is going to be the impact of this. And you know, right now, I think it's the theory papers that might be best answering this question. What do you do when you remove this implicit subsidy to research? Does it have an effect? It will take time to understand you know, empirically what happens, but it reminds me a lot of decimalization in that when we went to penny tick size, that was blamed for killing all the small dealers who couldn't make money in the bid-ask spread, and that was bad for small companies. And the Jobs Act actually required the commission to do a tick size pilot, which they did, and research is now being written. I think the results are going to be that with this pilot, which was, you know, in Christian Lloyd's perfect world, a randomized experiment to see what the effects are when you change the tick size, I think the results are going to say that I don't think that that's what killed, you know, the small dealers. And, you know, what's absent from a lot of these studies and discussions is the information, how it's being accessed, who's accessing it, and how decisions are being made. And I think it's true that a lot of the disclosures are being ingested by very large investors and hedge funds, and the marginal investor is not, you know, the investors that were, you know, 10 years ago. And so the cost of collecting information, analyzing it is a big part of the equation.
If I could just say one more thing on that, it's actually given rise to another field that's called paid for research, which is what it sounds like, and it needs to be disclosed. And, you know, I think it's probably still a little early to know what that impact has been for the small companies that are availing themselves of it. We've seen actually full firms go to pay for research. And it tells you that obviously issuers value having a third-party validation, but it does kind of make you wonder, like, if you're paying for it, obviously there's some entanglement, and I mean, my clients don't do it, but there is that it exists out there, and it's something that we're gonna have to grapple with, and there'll be some good research, I think, coming out of that eventually.
Well, more so a question. I mean, as you're grappling with these issues of the decline of the sell side on a daily basis, I mean, where can we contribute? What questions can we help answer, you know, in terms of providing academic research that is hopefully very directly applicable to this challenge you're facing on a daily basis?
You know, I think about that all the time, because issuers tend to believe the more analysts they have, the better valuation they'll have, the less volatility they'll have, the more opportunity they have to get out and meet with investors. Because at the end of the day, to your point, you know, while investors are ingesting a lot of disclosure, meeting management teams is what, every time I do a survey, that's what they say they want. And I'll also tell you that every time we do perception studies of buy-side investors, we always ask them to rank the sell side. And most of them, typically 85% of them say, oh, they're of no value. It's a waste of time. And then I'll go back and we'll check, and we're like, well, but they are using all of them. So, you know, you get a situation where, you know, sometimes the incentives aren't always aligned. You know, I think it's going to be interesting to see what we're going to evolve to. I'm hoping we've sort of hit a plateau in terms of, you know, we won't see more major firms shut down, which we've seen. But it'll be interesting to see, you know, how have firms fared when they've gone from 5 to 1 analyst? You know, as management believes, you know, has the volatility increased? Has their valuation been impaired outside of business performance? You know, so.
I think there's probably 10 research questions in there. Let me move on to the last one, and then we'll take a few questions from the audience. So this is something Mary and I talked a lot about. She wears many hats as an IR person. And the world of disclosure is changing. You know, maybe there's even some questions about whether we move away from quarterly reporting, for instance. Firms are able to communicate with the market directly now through social media. Are disclosure regulations keeping up? Are they inhibiting the flow of information, or are they making it more efficient? Do we have the right rules in place over the modern disclosure environment? And what about enforcement with all of this?
Likewise, there's a lot of questions in that one question. It's very hard to say at the start. I mean, the quarterly reporting, I don't hear a lot of requests from the issuer side to change that. I think there's a great fear amongst issuers that, you know, it could potentially lead to more insider trading, because the information is going to get out somehow, right? And you worry about your ability to control. When you're on a regimen of every 90 days, you know, you feel like you can control that better. There's always going to be inadvertent disclosures, and there's good policies, I think, and procedures around how that's managed. But has regulation kept up? Not entirely. As I mentioned before, one of our big challenges is we can't identify our shareholders. So, and that's just a big limitation. You have people calling all the time, I'm a top 10 shareholder. I don't know. You know, they might have been, but, you know, so when I talk to companies, the only thing we can control is how we use our time. And so management's time is incredibly valuable. You want to make sure that you're using it with the right people who are going to be able to, you know, understand your story, hopefully become shareholders or become bigger shareholders. So if you don't know who your shareholders are, you've got a conundrum walking into that interaction. You know, I'm not even going into the short sellers and the you know, all that kind of thing. In the bear case, you know, when you get a short attack, things like that are tremendously disruptive. Activism, that short attacks and activism, I think, are very poorly regulated. I was at a senior roundtable within NERI just 6 months ago, and we had this long discussion with someone from the SEC about that. And I don't think that the perception was as he wasn't certainly as aware of how these attacks can really be persistent, and they can be coordinated, and they can do tremendous harm. And there's nothing. The issuers are very limited in what they can do. We have all the control, all the rules and regulations on us. So that's on that side. On the other side, in terms of have the channels changed? Yes, but when people say, oh, social media is now becoming the channel by which people relay disclosure information, I'd say to some degree. I don't have a Twitter feed, so I think companies use Twitter or any kind of social media as just one more piece of the puzzle. Obviously, a company that's more consumer-facing is probably using it more. Or a company that is B2B and has a really well-established marketing function within their social media is probably using it more. But the number of companies that are thinking that social media is their disclosure, forum, that they're leading with that is very small. A lot of times, we see things like, was it Netflix or Yahoo at one point decided that they were going to do videotaped quarterly calls. That didn't last very long, did it? So you see some of these things, you think, it's an idea, but does it serve the function that it's supposed to serve? That's really what it comes down to. Is it conveying the information to the right people on a timely basis? And that's what you need to think about. Apparently that didn't, so that's why that doesn't exist. I think what you really need to think about as a company is you need to develop expectations for how you're going to communicate with investors. And those expectations need to be shared and repeated, rinse and repeat, so that they're not expecting you to come out at 2 in the morning with something because you've never done that before. So, but if you do that all the time, then I guess your investors stay up all night. But I think most companies have now developed a pretty good pattern, and that's what we always encourage companies to do. Develop your pattern, stay with it, make sure that you use all of those channels to reach investors.
Scott, do you have thoughts on that from the SEC side?
Yeah, a couple of thoughts that may be relevant, at least to the academic community. One is in terms of a decade at the SEC working with attorneys and accountants on what should be disclosed. What I found was that there were generally compartmentalized discussions. If it's talking about executive pay, let's talk about what components should be disclosed and how, or components of the management discussion analysis or whatever it was. But when you discuss a component, you don't think about the document holistically, and so you get to this issue of information overload. When you look at all the disclosures, they've gotten to become very big, but as soon as you try to drill down and assess what to get rid of, somebody's going to make an argument about why it's material and it should stay in. And so we've been through 4 years of trying to skinny a 10K, and not much progress was ever made. So what I think would be useful is introducing a concept of economic materiality, something different than from a legal term, which is from an asset pricing model, what actually matters in these disclosures and is used, and what can be inferred in the sense that you don't have to disclose certain items, but inferred from other information that's not really necessary. That has never been done inside the SEC, and I think it would be useful if something like that could be done. So we took an angle of saying any one of these elements would be useful, but when you've got like a principal component analysis, I can get rid of these 30% of them because I can infer it from other disclosure metrics. That would be something that would argue along those lines, might help a regulator address some of the information overload. I think it is true nobody reads a 10K cover to cover. When I did my research and my PhD, I actually went through thousands of proxy statements from the 80s and 90s, and there were 3 or 4 pages, and I could actually read them. There's no chance or hope of doing that now because they're no longer written to be read. And so you can lament that or not, but that is something that would be useful. Another area that it just reminded me, listening to Mary's remarks, is Lucian Bebchuk, when I was in government, used to invite me to his Harvard roundtables on shareholder engagement and corporate governance. He dropped me from that list now that I'm gone, but one thing that came up inevitably in almost every meeting was Reg FD. It's not something I don't think is researched a lot today, but I remember when Reg FD, was first rolled out, there was arguments about market efficiency being impaired because the flow of information be curtailed under, the fairness argument. Well, that exists today with shareholder engagement, particularly as companies are trying to get independent directors out talking to the IR community and to the big investment managers. And there's a whole discussion right now on the legality of those conversations and whether it is comporting with Reg FD or not. I haven't seen a lot of research on whether or not there's been an economic impact from the increase in the last decade or 5 years in particular on having those communications.
Maybe I'll pick up there, because one of our biggest concerns with getting rid of quarterly reporting is Reg FD issues. And you might not realize that increasingly we become privy to material non-public information, and it is just a tax on our business because the way we have to report it up into their counsel and our counsel. And if you're taking the executive out from the market, he doesn't have a routine chance to kind of clear the air, so to speak, or update. And if you have more of these executive meetings with large investors in between a half year, call it a year reporting to be extreme, you're just opening yourself up to more Reg FD risk all around. Sell-side research, the buy side. It's amazing what we have to do to try to protect our clients from getting material non-public information. Given some of the enforcement actions on hedge funds recently, they are very serious about not receiving that information. And so that's one of our main concerns. That said, I think it's probably logical to conclude that some information would accrue to those investors that get those meetings. And I think that does kind of separate the large investors from the small investors as well. So those are some of our concerns on particularly quarterly reporting. And just on disclosure overload, here is an area where technology, particularly for the investors, has rapidly advanced. And we might not read it. I actually still read a 10K from cover to cover every now and then, but many don't. But there's things like AlphaSense. They're basically like Google's for disclosure. And you can find whatever you want across multiple companies literally within seconds. And those tools are very powerful. They're expensive. They accrue to large investors and analysts like ourselves. They don't accrue to smaller investors. So that's something else, just this gap. And I think technology is driving this gap between larger and smaller constituents.
Actually, I'll say something about that too. I mean, in terms of areas to think about for research, how companies handle, I'll give you an example. When a company is thinking, do I have to do a pre-release, which is, when they've given guidance, for instance, or they look at the consensus and they're going to miss it by what they view as potentially material. A company that decides to do a pre-release versus a company that doesn't do a pre-release and just reports, bad results. What is the outcome on those companies? And you can easily do that using AlphaSense now, or something like that, looking for keywords. So there's a lot of areas that would make for really great research in terms of providing really good information back to issuers about best practices and outcomes that aren't simply tied to stock price performance. I mean, sometimes when I see research, it's they're looking at, like, for instance, I just saw one last week about staggered boards within the S&P 500. Well, the N was 18. Okay, so. And their conclusion was that staggered boards are actually beneficial. I was like, well, that's probably because two of those companies had really great performance, right? So it doesn't mean that they're good or bad. It's all you're doing is evaluating their stock price. And at the end of the day, if we've done all of our jobs well, the stock price should reflect the business performance. It shouldn't be a matter of other whether they have a staggered board or whether they are located in the Midwest or whatever the factor is today. So, but there's lots of really great things that one could look at in terms of how companies do practice their disclosures, what things they do, and that would be very fertile for research topics.
Can I just ask a follow-up question? So we do focus a lot on stock price and returns. What are the other metrics that you think about as being important to the managers?
So that's a great question. I mean, at the end of the day, people do look at the valuation. Valuation is really important. So, but I would say relative valuation is maybe more important than stock price performance, because that actually would, for like an industry, that would include everyone's performance, right? So you would say, if something bad happened, or banking industry, whatever, if people were depressed in general, how was your relative performance? And then other times companies are going to be looking at other metrics, revenue growth, so there's you can and what, depending on where they are positioned when you start, is it EPS growth? So you can look at a number of different metrics. I think that would help define who did what and what were the outcomes positive.
All right, I think we should have at least 2 token questions from the audience.
I'll make a brief comment that will lead to a question. I just want to say Scott's remarks were amazing. I spent a year in the chief accountant's office in the SEC, and if I'm remembered in that group at all, it's probably for colorful tirades about the problems with XBRL. I won't get into all of them, but there's a lot of incentives not to fix it and not as many incentives to try to fix the problems. And so what Todd said is that basically investors have just worked around them and just rely on these data providers to kind of get what they need and get information quickly. But that gives these data providers a lot of power. And so are any of you concerned about that there's not oversight? They're kind of defining what earnings are that the market cares about. We're not looking at GAAP earnings. And I think even the IR community has to interface with these providers and say, we think the consensus in our stock is this, but the provider really defines the consensus. So I'd like your thoughts on that.
I'll hop in right there. There are a number of data providers, and many of us, if you have a number of analysts covering you, for instance, sometimes when they're reporting consensus, Bloomberg reports it one way, FactSet reports it another way, and you actually have to go and kind of battle it. You also can have errors. Errors show up. I mean, I've had clients where somehow, we don't know how, but Reuters or AP picked up something wrong. They pulled it off an aggregator out of India. And so, I'm spending a lot of time fixing that, and maybe it's a headline, whatever. So a good IR person is always looking at that, because when that bad data gets in there, if you don't get rid of it right away, it will go on forever.
So from my experience as a sell-side analyst, I think generally the company defines the metrics that, in the context of those metrics that sell-side use, and that's because they have to conform.
Right.
There's some strengths and weaknesses to that. There's issues where companies don't include stock-based compensation. Maybe I think that's a real cost. But if I include that in my base, then I'm kicked out of consensus. So generally, they all herd to what companies produce, and there's pros and cons for that. The other thing I'd highlight, there are new evolving consensus providers, and particularly for this group. If you've ever heard of Visible Alpha, I would look that up. What they do is they take, I don't know if you're familiar with it, brokers send all their models, and then they basically have a team offshore that build taxonomies per each individual company. And so 40 people covering Apple, they'll take 40 models, they'll map individual line items, and so you basically have a super consensus now. It could be iPhone units, iPhone ASPs, all the way to the revenue build, fully down the income statement, full balance sheets. So you're talking thousands, in many cases, of lines that you can see consensus on. So that's the way that the technology is evolving.
All right, I think we are actually out of time. I'm sorry, Stefan, maybe you can catch them on the break. Let's give a huge round of applause to our panelists.